In this session, I am going to talk about the different applications of the discounted cash flow, or probably the different applications of the time value of money. Why we are talking about discounted cash flow similar to time value of money? Because even in time value of money, we have talked about discounting the future cash flows to the present value, finding out the future values, finding out the present values. So, using an appropriate discount rates. So, now what we will do is we will get into understanding of the real world applications, because as financial analysts we keep looking at the usage of time value of money day in and day out for all kinds of decisions, right? Time value of money plays a very key role in many financial aspects, whether we are evaluating equities, or you are evaluating fixed income securities, or we are working with derivatives. Almost every aspect of finance, or we are doing any kind of portfolio management, almost every aspect of finance typically involves some form of the time value of money application itself. Because in short, whenever we are dealing with finance, it's as good as we are investing something today, and we are going to get some cash flows in future. And these cash flows, the timings are different at different points in time, and the amounts could be different. So what we are typically seeing is, whatever I need to invest today, is it really a good investment or not? Or if I am investing something today and I am getting something like this, what is the kind of return that I am getting during this entire process? All these are typical applications of time value of money itself. So that's where, to start with, as a part of the agenda of this particular session, I'm looking at three major dimensions. One, discussing two important tools which use time value of money heavily, which are used in so many decisions. One is NPV, which is the net present value, as a decision taking kind of a tool, as well as the IRR, the internal rate of return. So this is one kind of tools, one set of tools which are typically used for a lot of investment decisions. So we will try to which use in fact the discounted cash flow or time value of money as a concept itself. Then we'll try to see the applications relating to portfolio returns, portfolio return measurement, which again uses the concept of the discounted cash flows or time value of money. And I would also like to look at another concept relating to the yields on the money markets. So three major dimensions I would like to cover as a part of this session. So initially I'll start off with the net present value. So just to get started on that, majority of the investment decisions in finance require the good understanding of NPV as well as IRR, very commonly used buzzwords as a part of various areas of finance. So right from corporate finance, which is to do with so much of internal decision making processes, as well as the security analysis also, which is more to do with investment decisions in equities, bonds, etc. So both the corporate side of finance as well as the security analysis side of finance, they heavily use the concepts of NPV and IRR. So here if I look at major sections, one is capital budgeting, which typically talks about allocation of funds, or probably investing in long term projects. What kind of projects to choose, which ones to accept, which ones to reject. Decisions relating to long term projects and the investment in those long term projects go with capital budgeting. Then we look at capital structure. Even there I look at the NPV and IRR, wherein I am again looking at how much for meeting these investment requirements, how much capital to raise and in what form. Should it be raised in the form of debt? Should it be raised in the form of equity? If it is raised in the form of a debt, what is the cost? If it is raised in the form of equity, what is the cost associated? So that's one decision that requires the evaluation from this dimension. And we are also looking at a place of working capital management, where we are talking about managing the short-term assets and liabilities of the firm. So all these things, some of the key aspects as a part of the functioning of a firm, they are all handled through the understanding of these concepts of net present value and IRR, going as a part of corporate finance decisions, which use the concepts of discounted cash flows to a large extent. So first of all, what is this net present value and what is this internal rate of return? So one of the first point I can talk of, both of them are, these are the methods which are generally accepted heavily in the industry for valuing the investments and choosing which one is better. If there are many alternatives with respect to investment, choose among the different kinds of alternatives. So while NPV is one method, the IRR is the other important method. So we can very well get into finding the value of an investment, and if there are multiple such kind of alternatives that are available, I can very well choose the best among them. And when I talk about NPV, the way it works out is, it looks at finding the present value of all cash inflows minus the present value of all cash outflows. So that is what is coming out as the NPV of the assignment. So the net is because inflows are treated with a positive sign, the outflows are treated with a negative sign. So whatever is the net that is coming out, so NPV could be either positive or negative. So whenever we are looking at how do I compute, my first step is identify all the cash flows. Okay, so let me take a simple example. I will look at different time periods, right? Let me think of time periods. So time period T, let me say right now, 1 year from now, 2 years from now, 3 years, 4 years. Let's say I am choosing between two investment projects. I'm choosing between two projects. A project A, which requires $100 million investment, but let's say it's going to give a cash flow of $10 after 10 million after 1 year, 70 million after 2 years, or probably 80 million after 2 years, 60 million after 3 years. Let me take it as a 3-year project. Now on the other side, I have a project B. Even in that I am investing, I have to invest 100 million. Let's say it's going to give me 70 million in the first year itself, 50 in the second, and 20 in the third. So if I am simply looking at, I have invested 100, I have got 150 million in this project. I would be getting 150 million in this project. These are the future projected cash inflows. This is a cash outflow. Even here cash outflow is 100 million, but I am going to get 140 million in this particular project. Right? Now I have identified all the cash flows associated with the project. So the first step in finding out the NPV is identify or probably estimate what are the future cash flows that are going to come up from that particular project. So using experience or using any other mechanism, estimate the various cash flows that can come. If at all any other intermediate outflows are there, just even identify them. And after that, identify an appropriate discounting rate. Discount rate is nothing but the rate at which you are discounting the future cash flows. Probably the better one to use is the opportunity cost. In this case, I am investing 100 million in this project, means I have lost the opportunity to deposit it probably in a risk-free investment and get a return of some risk-free rate of return. I could have deposited the same 100 million in a bank and I could have got a rate of return of R. But I am losing out that much of R because I am investing in this particular project. So that R, which is that interest rate which I am losing, is what is the opportunity cost, which I would be taking as a discounted rate in this particular case. So just for understanding, let me take in this case the discount rate, let me take it as 10%. Right, for this example, let me take the discount rate as 10%. Now find the present value of each of the cash flows. Using that discount rate, find the present values of each of the cash flows. So I can very well find out. So this divided by 1 plus R to the power n. So the present values in case of project A are going to be this much. Similarly, I can find the present values of the project B as well. This divided by future value FB divided by 1 plus R to the power n. So these are the cash flows, the present value of the cash flows in each of these cases. So in this case only there is an outflow only in the 0th year, which is the initial investment, but after that the cash flows are completely positive even for both project A as well as project B. So in this case, after that I am getting into the summation of sum of all present values. So if I am looking at the sum of all the present values, here I am seeing that this value is around 20.28, but if I am summing up all this, it's going to be 19.28. So in this case, the first one is having 20.28 as the net present value and the other one is having 19.98. So I have computed the NPVs. So this is the net, because there are some positives, there are some negatives. So whatever has come out is the net present value. Now, if at all I have to use NPV for investment decision purpose, the rule is quite simple. NPV is positive, accept the project. NPV is negative, reject the project outright. So a project or investment accept or reject decision using the NPV rule is straightforward. If it is positive, accept it, otherwise you reject it. But the problem comes when, in this case, let's say these two are having NPV of positive. Both the projects have an NPV positive. So I can very well accept both the projects. But if I have to go with both the projects, I require 200 million capital today. But let's say I don't have that much of capital with me. I am having a restriction of only 100 million. I have a capital budget restriction. I have a budget restriction of only 100 million, which means I have to choose between this and this. Only one project needs to be selected. Those kind of situations where I can select only one of them, even though both of them are positive as per the NPV rule, but I have to choose only one of them. We call those kind of projects as mutually exclusive projects. And whenever we are getting into mutually exclusive projects, I have to choose that particular project which is having the highest NPV among the two. So which means in this particular example, the project A would be selected because it is giving me an NPV of 20.28 compared to an NPV of 19.98 offered by the second project. But here let's look at, what if my discount rate becomes 12% instead of 10%? If my discount rate, which is the opportunity cost of the investment, is becoming 12 instead of 10, rest all remaining the same, my NPV for project B is greater than the NPV for project A. So this is a very interesting thing. Depending on the discount rate chosen, my NPV decision could change. Either I may go with a project A or project B depending on what is the discount rate that is applicable. In this case, it is showing that project B is having a better NPV compared to project A, but when we have chosen a discount rate as 10%, probably I am going with project A. Now here what is very much important is, this discount rate primarily is nothing but the opportunity cost of capital, which is purely determined by the market forces. So whatever is the opportunity cost at that point in time, this is not chosen by me explicitly, it has to come from the market. So whatever is the rate we are inputting, so it's more realistic. And it is reflecting the current situation of the market. So whatever is that particular rate, I input that particular rate and compute the NPV. So because we are taking it as an opportunity cost, so we are foregoing that much percentage, which means any investment that is still giving me a positive NPV is worth taking up. But if I have to choose only one among them, I'll always go with the one which is giving me the highest among all those positive NPVs. So that is where we are looking at all the cash flows, discounting them to the present value and summing up all those present values. But one piece of advice here, if I am taking the cash flows, again a compatibility is something that we need to test. If I am selecting the cash flows on an annual basis, if I am selecting annual cash flows, even my discount rate should be annual. But if I am selecting quarterly cash flows, even my discount rate needs to be quarterly. That's one more important aspect which we have discussed even in time value of money. We need to still consider out here. Alright. Now let's move on to a second example or a second important topic, which is the internal rate of return, which we call as IRR. So this is like In general also, probably if I'm doing some investment now, so here if I look at this project, I've done some investment of 100 million. Now I'm going to get 10 million in 1 year, 80 million in another year, 60 million in the other year. Now if I am really interested in finding out overall what is the return that my project generated that my project will generate over the next 3 years. What is that annualized rate of return? What is the return that my project will generate over the 3 years? What is my annualized rate of return over this 3-year period? So I just am more interested in a single number which showcases what is the return of investment. If I'm investing $100 million today, I'm getting 10, 80, 60 in the next 3 years versus getting 70, 50, 20 in the next 3 years. So that particular one single number which talks about the rate of return of an investment when there are different cash flows occurring at different time periods. Overall, if I am talking about one single number return, that is what I am calling as internal rate of return. And just to make things easier, it is that particular discount rate, just from a definition perspective, it is that particular discount rate which makes NPV equal to 0. Which means the present value of cash inflows is going to be same as present value of cash outflows, or the NPV of the typical investment is going to be 0, right? And probably why internal? It is purely internal because it's coming purely, though no other additional external data I'm taking. I'm purely taking the cash flows internal to the project, and based on that I'm trying to find out what is the IRR for this particular project. The same application of IRR, typically when I am taking it to the world of bonds or fixed income securities, the same concept of IRR gets translated. Equivalent word of IRR in case of bonds is nothing but yield to maturity. When we talk about yield to maturity is nothing but the IRR. Even the portfolio, when I have to take the same concept of IRR to the portfolio management world, we equate that to money weighted rate of return. We'll talk about it slightly in the later. Money weighted rate of return. That's one more concept where similar IRR is being utilized as a feature. Now, the only thing here, let me try to compute the IRR. That makes things slightly easier for us. So in this case, in the first case, if I have to compute, most normally these IRRs can be computed through spreadsheets quite easily, or probably using a financial calculators rather than manually trying to find out. But my intention when I have to find out manually is, if this has to become 0, at what rate, what discount rate will make the sum of the present values or the NPV equal to 0. That is what is working out as IRR. So probably just to test out, there is a simple formula in Excel which can help me to find out the IRR of the project. So I'm simply finding out the IRR in this case coming out to, let's say, 19.26%, whereas in this case the IRR is coming out to 24% or 23.56%. So the rate of return which this project has generated is 19.26% on an average on an annual basis. This particular project has generated a rate of return of 19.26%, whereas this particular project has generated a rate of return of 23.56. If all these go as per our expectations, in this project we are going to make 23.56% return, whereas in this project it's going to be 19.26% itself. But a few small drawbacks existing, or probably a major drawback. So let's say if I am saying IRR of the first project is 19.26% and the second project, let's say, is 23.56%. Let's just observe it. Let me just replace this number. Let me just replace this number with this. What I see is the NPV is exactly 0 here. Right? If I am taking 19.26, the NPV is exactly 0 here. That is where it has come out that this is the IRR. But in this process, what has happened? This cash flow 10, I have discounted it by 19.26%. This I have discounted it again by 19.26. This I have discounted it again by 19.26, which means all the cash flows I am discounting them with 19.26%, which may or may not be realistically an opportunity cost. Or in other way, the IRR assumes that any intermediate cash flow that is coming, it is reinvested at IRR. Only then we are going to get the IRR return over the entire period. If at all it is getting reinvested at anything less than the IRR, our returns are going to be much lesser than IRR. What I am trying to say here is, just to give you this example, okay, the 10 I am getting, this is the 10 I am getting at the end of 1 year. Now what this is assuming is, whatever the 10 that I am getting, I will be reinvesting this 10 for 2 more years at 19.26%. I will be reinvesting this 10, whatever I get at the end of 1 year, for 2 years at 19.26%. The same way, whatever I am going to get 80 at the end of 1 year, I am going to reinvest it at 19.26% for 1 year, and probably this nothing I am going to reinvest, which means the overall future value at the end of 3 years is going to be this much. And that is where, if I am trying to find out the rate, which will work out as 169 divided by 100 to the power 1 by 3 minus 1, which is working out to 19.26%. But whatever the 10 that I am getting at the end of 1 year, what is the guarantee that I will be able to reinvest it at 19.26%? It's literally close to impossible, because finding a project or finding an investment which can give me 19.26% return guaranteed is something that is very hard to locate. So which means it may so happen that I may be forced to reinvest whatever I am getting. I may be forced to reinvest, let's say, at just 10%, which is the market rate of interest. If that's the case, what I am typically getting is just 16.98% net, not the IRR of 19.26. So what we are simply saying is, IRR is having a small limitation. It assumes that whatever the intermediate cash flows that we are getting, all the intermediate cash flows that we are getting, we are able to reinvest exactly at IRR. In case we are not able to invest them at the IRR, but we have been able to invest them at much lesser than the IRR, what we could see is the overall return that we are getting over the 3-year period is typically going down. So that's one more point that we need to be very clearly understanding in this concept. So even here, if I am saying that I've got an IRR of 23.56, it's only under that assumption that intermediate cash flows are getting reinvested at 23.56. If I'm not able to reinvest them, that is where the overall return is completely badly affected. So IRR generally computed using the various spreadsheets. And when it comes to the decisions, when it comes to using IRR for decisions, where we talk about the IRR rule, simply it says accept any project if the IRR is greater than the opportunity cost of capital. If the IRR is lesser than the opportunity cost of capital, probably reject the project. So in this case again, here if I had taken the opportunity cost as 12% or probably 10%, what I could see is the IRR is 19.26%, which is greater than the opportunity cost of capital, which is taken as the discount rate. So I can very well go ahead accepting the project. Even here we could see that the IRR is greater than the opportunity cost of capital. So I can very well go ahead investing in the project. But if at all my discount rate had been, let's say, 20%, my IRR is less than the opportunity cost of capital, so which is resulting in NPV also going negative, so I can directly reject the project. But this project I can still accept because IRR is still greater than the opportunity cost of capital. So this opportunity cost of capital sometimes is also called as the hurdle rate. So this is that minimum interest rate or minimum rate of return, that every project needs to exceed, minimum rate of return that a project needs to give for it to be accepted. So another relationship wise, whenever we are seeing IRR to be greater than the opportunity cost of capital or probably the hurdle rate, what we see is NPV will be positive, IRR is equal to opportunity cost of capital, we see NPV will be 0, and where IRR is greater than or less than the opportunity cost of capital, project NPV will become negative, and that is where that particular project needs to be rejected. So even this is kind of a relationship in general which you can observe between the NPV as well as the IRR. So that's one important thing that we can look up in terms of the understanding between the NPV and IRR. Now, as I have just now discussed, there is one small problem with respect to IRR. As we have just now seen, the IRR makes an assumption that the intermediate cash flows need to be reinvested at IRR. Only then the IRR is having its validity. So when I am now taking this particular concept to the evaluation of investment decisions, when I am taking this concept to the evaluation of investment decisions, what I typically see is whether I am using NPV or IRR. NPV or IRR, the decision is the same, accept versus reject decision is the same, as long as the projects are independent. If I am looking at the projects in isolation, or the decision to invest in one project does not affect the decision to invest in another project, So those kind of projects I call them as independent. Means as long as both the projects have a positive NPV, accept. Even if there are multiple projects which are giving me a IRR greater than the opportunity cost of capital, accept. And this decision will still be the same, because as I have simply said, whenever we see that the IRR is greater than the opportunity cost of capital, we almost see that NPV is positive, which means the both of them are saying accept these projects. Similarly, when I am seeing the other way, IRR is less than the opportunity cost of capital, results in NPV being negative, and both of them, NPV rule as well as IRR rule, both of them saying reject the project. But the major problem comes only when we are looking at not independent projects but mutually exclusive projects. As I have defined earlier, mutually exclusive projects is, even though I have two projects which are qualifying for accept, I can take up only one project. I cannot take both of them for whatever reason. If that's the case, I really need to get into the ranking of the projects. Which one is 1, which one is 2. Because both of them qualify for accept. This is where there is a possibility that IRR and NPV conflict can come up. IRR NPV conflict can come up, and this is the common scenario. In this case, whenever we are getting a conflict, what is typically suggested is we go with the NPV rule, which means whichever the project is having the highest NPV out of these two, whichever projects. So now if I am going with a discount, discount rate of 10% or opportunity cost of capital of 10%, here my project A is giving me a highest NPV. So I'll typically prefer going ahead with project A rather than project B. And just to understand where all the differences can occur, especially the size of the projects. The size of the project is where I could typically visualize a difference in the decision given by NPV versus IRR or the timing of cash flows. Two major areas where there could be an issue with respect to the NPV versus IRR. Just to discuss a simple scenario. Let's say I am talking about two different projects, A and B. I am talking about two different projects, A and B, wherein in A, let's say I have invested $1,000, and in B I have invested, let's say, around $3,000. And let's say it's a 1-year project. So A has generated 1,500 overall, whereas B has generated, let's say, 4,000 overall. Right? Now, if I am simply going with the IRR rule, which is a 1-year rate. So, if I am going with IRR in this case, the IRR is around 50%, whereas if I go with IRR in this case, it's just 33%. So, based on the IRR, if I have to choose the project, probably I should choose project A. But if I go with NPV, right, if I am going with NPV under the assumption of discount rate of 10%, so probably I am looking at, I'll compute the NPV at a discount rate of 10%, then probably the net present value here is coming out to, let's say, 363, right? The NPV is coming out to 363 in this case, whereas in the second case, the same NPV, if I am applying with the same discount rate of 10%, all I am able to see is the NPV in this case is almost 636. So the NPV rule is typically saying we should go with project B, whereas the IRR is saying you should go with project A. So this is where the size is mattering a lot, and in this case I will choose going with project B rather than a project A, because any positive NPV is actually adding to the shareholder wealth. Whatever that 636 is, that is an increase in the shareholder wealth. Now, whichever project contributes to the maximization of the shareholder wealth, that is the project that needs to be accepted. So the first one is contributing only 363 to the shareholder wealth, whereas the next one is contributing 636. Because any company, the major financial objective of the company is shareholder wealth maximization. So whichever the project maximizes the shareholder wealth, that needs to be accepted, and NPV is directly any positive NPV is increasing the shareholder wealth and the negative NPV is decreasing the shareholder wealth, which means a straightforward reason why NPV rule should be preferred more compared to the IRR rule. The same way, probably if I am looking at another example which is relating to the time, which is related to the timing of the cash flows. Let's say in year 0, year 1, year 2, year 3. I am investing 1000 here and I have got, let's say, 1500 here. Whereas here probably the size, let it be the same right now, but I am getting something, I'm getting something, let's say at around 2200 or 2500 at the end of 3 years. Now let's try out how much is coming through the IRR rule, how much is coming through the NPV rule. In this case, when I'm looking at IRR, probably this IRR is giving me 50%, whereas here the IRR is coming out to 36%. So which means it is very much clear using the IRR rule that I have to accept the project A. But what if I am going with an NPV rule? If I am going with an NPV rule with a discount of 10%, right? If I am going with an NPV rule with a discount of 10%, in case of project A, it is coming out that my cash flow is 363 bucks, whereas my NPV is a positive 363. Whereas when I am going in the second case, it is working out that the NPV is going to be 878. So again, the NPV is contributing more and more to the shareholder wealth, and that is where here also you see size is the same, but the timing of the cash flows are different, and that is what could very much provide a different value to the NPV as well as to the IRR. But what we are simplifying is, whenever we are getting two different rankings between the NPV and the IRR, the decision is quite simple. Choose that particular project which is giving me the highest NPV, not that particular project which is giving me the highest IRR. Because as we have already discussed as a problem with the IRR assumes that all intermediate or interim cash flows, they are getting reinvested at the rate of IRR itself, which is slightly away from the market reality, because the NPV assumes that all the intermediate cash flows are reinvested at a external market based discount rate, which is more and more realistic because it looks at the opportunity cost of capital, and reinvestment is assumed that it will happen at that particular rate. Whereas so they are more and more realistic, more and more economically relevant to the current world scenario. So because most of the market determined stuff is going as a part of the discount rate. So whatever is the real addition, so whatever is the positive NPV that is coming out, it is very clearly visualized that it is going to be a definite addition to the shareholder wealth. And anything that maximizes the shareholder wealth, that should be a better tool in terms of decision taking. So that is one major application of the discounted cash flow or time value of money, which plays an important role, in terms of financial decision making. All right. Now let's turn our attention to the next important usage of the discounted cash flow, where I talk about portfolio returns measurement. I'll look at the aspect of measuring the returns of the portfolio, or probably what we typically call as the performance measurement of the portfolio. Now, for us to assess the success of our investment, we are doing a good performance measurement, which means it has to be a very logical calculation of the returns and it has to be more and more consistent. So here we'll introduce one important term called the holding period return. Sometimes people call as holding period yield or holding period return. What we typically define it as is whatever is our holding period. So right from the time I buy it to the time I sell it. So a specific period, any period that I am defining, whether I buy or sell, let's say I want a 3-monthly return or a 1-yearly return or a 5-yearly return, whatever it is, that is what I am calling as a holding period. Right? It's like a one single period from the start to the end of that particular period. That is what we are calling as holding period, and whatever the return that is going to come during that holding period we call as the holding period return. So the way that is getting defined is whatever is the price at the end of the holding period minus the price at the beginning of the holding period plus whatever are the intermediate cash flows that have come during the holding period, which we call as dividends. If I am talking about a stock, the price of the stock at the end of the period minus the price of the stock at the beginning of the period plus the dividend that I have received during the period divided by the price at the beginning. So this is what we are calling as the holding period return. Whatever is the change in price, we are talking about the return is coming from two dimensions. One, because of the change in price. Two, because of intermediate cash flows that have been received during that period. So the summation of these two as a ratio of the initial investment, which is the beginning of the period price, is what we are calling as the holding period return. And for appraisal of any kind of a portfolio performance, we are using this holding period return as a base. The real problem comes in terms of the measurement of the portfolio. The real problem comes when I am treating of performance measurement over multiple periods. We are talking about if I have to do a performance measurement not just for one holding period but over multiple periods, what is the way that I should typically look at? Especially when I am talking about multiple periods, we may have the scenarios where new capital can come after some point in time, or some withdrawals can happen after some point in time. If these are the various things that are coming out and my portfolio is changing dynamically, what is the typical measure that I should go for evaluating the performance of the portfolio? In this context, we talk about two different measurements. One, we talk about money weighted rate of return. Money weighted rate of return. The other one we are talking about is the time weighted rate of return. What it is, what these two things are, how we differentiate these two things, we'll try to work it out. And just to give you a quick input, money weight of return is more or less similar to the concept of IRR, which we have discussed as one of the important applications of time value of money or discounted cash flow. So let's get started. Let me take up one small example which can illustrate this concept of differentiation between a money weighted and a time weighted rate of return. So here let me talk about two different time periods over a 2-year period. Over a 2-year period, so let's say I am talking about the first scenario wherein I have spent in time t equal to 0, whatever has gone in. Let's say there was a spending of $100. I've spent $100, and let's say after 1 year, the share price of the stock, I've purchased one share of a stock, and at the end of 1 year, let's say the stock has gone to 110, and I have purchased one share even at that point. And let's say at the end of 2 years, I have sold these two shares. I have sold these two shares probably at 225. Right? Let's say this is the situation for me. And here what I am saying is, here I have one share, and because I had one share, let's say a dividend of $2 has been declared on it, and here let's say a dividend of $4, means $2 per each share. Let's say I've got a dividend of $4 overall. Now if I am looking at the money weighted rate of return, first of all I am looking at all the cash flows in all the periods. Okay, because I am looking at the total cash flows in both the periods. In the first year, I'm having a net outflow of 108 because I have purchased one new share at 110, whereas I got a dividend of 2 in that period. So overall the net cost for me is just 110, whereas if I am looking at the third year, the end of the second year, I have received 225 plus 4. So the summation, the overall cash flow that I have received is 229. So based on this, if I am going with money weighted rate of return, which is nothing but the IRR in the case, the IRR in this case is working out to somewhere around 6.67%, right? So this is coming out as 6.67%. The money weighted rate of return is working out to 6 point. This is the way we compute the money weighted. So overall I am looking at, okay, in the first at the beginning of the investment period, I have spent $1,000 and purchased a share. So my overall cash flow is $100. but this one share has given me a dividend of $2 during the period. So I have got a cash inflow of 2, whereas at the same time I have spent $110 to really purchase one additional share. So I had a cash outflow of 110, overall resulting in a net cash outflow of 108 at the end of the first year. Similarly, at the end of the second year, I was able to sell both the shares at 225 altogether. But because I had 2 shares till that time, I had received a dividend of $4, which means my total cash inflow at the end of the second year is 229. Now we have already defined that the money weighted rate of return is nothing but equivalent to the concept of IRR. So the application of the same IRR has given me that the money weighted rate of return is around 6.67%. But let's dig a little bit down to try to understand what has happened during this scenario. Let me look at the holding period return for both the years. Right? Let me try to compute the holding period return for both the years. For the first year, what is the holding period return? P1, which is 110, minus P0, which is 100, plus the dividend during this period, which is 2, divided by P0, P beginning, which is 100. So the first year, the holding period rate of return was around 12%. Whereas what about the second year? What is that we have really invested? I have purchased, now the dividend whatever has come, let's assume that the dividend did not get invested. Which means the cash whatever I had, I had at the beginning of the at the beginning of the second year, I had 2 shares. Those 2 shares are worth 220. Right, at the beginning of the second year, I had 2 shares which are worth 220. So if I want to try to find out the holding period return for the second year, which is nothing but the price at the end of the second year minus the price at the beginning of the second year plus the dividend that has come out during the year divided by the price at the beginning of the second year. This has resulted just in 4.09 being the holding period return. And now if I try to find out the mean holding period return of these 2 years, what I am seeing is the mean holding period return is somewhere around 8.05%. But my holding period return has given, but my money weighted rate of return has given me a much lesser percentage compared to the mean. The reason being, the second year actually the performance was much weaker. The holding period rate of return was just around 4%. So the second year the performance was much weaker, but a greater weightage has been put on this particular year. The money weighted rate of return has put more weightage on this particular year and less weightage on this particular year. So that's the reason the overall weightage has tilted towards this side. Why did it put more weightage here? Because more money is invested here. 2 shares are there. More money is invested in the second year, and because more money is invested in the second year, what we are very clearly seeing is the weightage for the second year is much more compared to the first. And because the second year was a weakly performing year, a poorly performing year, more weightage on that particular year has reduced the money weighted rate of return drastically. But on the other side, if the second year had been a super performing year, more weightage being given to a super performing year, it could have increased my money rate of return drastically. So all we are talking of is because this kind of a mechanism puts weight on the returns based on the amount of money that is typically invested. If more money is invested during a period where the performance is poor, money weighted rate of return keeps going down. So typically, just to talk about, more money invested during the period of poor performance, money weighted rate of return is going to get affected very badly. But on the other side, more money invested during a superior performance, I see that the money weighted rate of return overall is going to increase because more money is being more weightage is being given to a high performance period, increasing my overall weighted rate of return. So what it means, the timing of the cash flows, when is more money coming into picture or when is existing money withdrawn. So either new addition or withdrawal. The timing of the addition of new cash flows or withdrawal of the existing cash flows is playing an important role in the determination of the money weighted rate of return. And to a large extent, addition and withdrawal of the cash is in the hands of the client of the investment manager, not with the investment manager, because when the client wants to add more money, he will add. Whenever he wants to withdraw funds, he can. But investment manager does not have too much of a hold on it. He cannot control the cash flow. In reality, cannot control the cash flow. Whenever the client wants to add, he has to take it. Whenever he wants to withdraw, he has to give it back. So, but in reality, the timing of the cash flow is impacting the return, which means the performance appraisal of the investment manager is purely dependent on when the cash is coming or when the cash is moving out of the investment, which should not be something for which he need to be penalized, because generally we talk about someone needs to be appraised only on things which he has control on or on his own actions, but not the decisions of someone else. But money weighted rate of return is clearly impacting the performance of the portfolio depending on when the actual money, when the new cash flows are coming in or the existing cash flows are being withdrawn. So that is where we see that money weighted rate of return is more and more sensitive to the timing of cash flows, and that's the reason it is giving more and more weightage to the money based weightage to the returns are being provided. More money during a high performance period, the return is going to be phenomenal. More money during a poor performance period, overall the money weighted rate of return is going to be affected. Now that is where the focus started moving towards identifying a mechanism which is not sensitive to the timing of the cash flows being added or being withdrawn. So that is what we are calling as time weighted rate of return. So the way we can simply look at the time weighted rate of return is, okay, let's look at each of the holding period returns. So these are the two different holding period returns. When I have these two holding period returns, so here what is that holding period return? First of all, here I will first identify how many holding periods are there. And these are typically identified based on the additions and withdrawals. Whenever a new cash is added, up to that time I treat it as one holding period. Whenever a withdrawal of some funds is done, again up to that point it is treated as another holding period. So whatever is the point where the addition of funds or withdrawal of funds is happening, those all are treated as different holding periods. So whatever is the period where the fund that was invested was the same, that is what is treated as different holding period. So probably let's say I'm starting here. Let's say here whatever it is, it could be 1 year, it could be 2 months. If new funds are added, new capital is added, so up to here before the addition of the new capital I'll treat it as a holding period. Now the new fund being added, up to, again let's say the withdrawal is being done at this point. So just before the withdrawal we are talking about the performance of the fund, that is treated as another holding period. Now the same logic goes, whatever are the new addition periods or withdrawal periods, just before the addition or just before the withdrawal, each one where the amount the amount invested is one single value for the applicable to that entire period, that is what is being treated as the holding periods. So there is the impact of new cash flows is not impacting, the impact of the new cash flows is not getting considered there, because we are looking at the holding period returns for each of the individual time periods once the fund amount at the beginning of the period is finalized. So we are trying to break into as many holding periods as possible, right? So for each base we are trying to find what is the cash outflow, what is the cash inflow. So based on this we are trying to find the holding period returns for each. Just to go ahead with this example, okay, a new fund has been added because I have purchased a new share. So what has happened is, just before the purchase of the share, I have spent 100, it has become 110, and I have got 2 as the dividend during that period. So overall for that period 12% is the rate of return or holding period return. But what about the second year? Second year I have invested another 100. So assuming that I have sold and I am restating the 2 shares that I have, they are costing me 220 bucks. End of the period they have given me 225 because I have sold it at 225. 4 is the dividend during that period divided by 220, so the holding period return is 4.09. So for the first period the holding period return is 12%, for the second the holding period is 4.09. Now the way I am trying to go ahead with time weighted rate of return is, I am taking the compounding of all the holding period returns. Holding period return 1, holding period return 2. This is the total compounded return. So it's as good as saying 1.12 times 1.0409. This is the compounded return, but this is a 2-year return in this case. So I'll take the geometric mean of these two returns, which will give me the time weighted rate of return. So basically when I have to go with 1 plus HPR for all these returns, right, I'll go with 1 plus the holding period return for all these returns, which will give me this one and this one. And here if I am going with time weighted rate of return, I am simply taking the geometric mean of these two returns and I am subtracting 1 from them. So this is giving me around 7.97%, which is more and more closer to my mean, because this is a geometric mean, this is an arithmetic mean. This is not impacted by the timing of the cash flows. So the weightage is not given to the money factor at all. So it is completely independent of when a fund is given to the system or when a fund is being withdrawn. So which means from an investment manager's perspective or from a portfolio manager's perspective, they typically see that this is much more reliable. So what we typically see is time weighted rate of return is more preferred way of assessing the performance of the fund manager, because the timing of the cash flows is something which is very difficult to assess. So when more funds are coming at unfavorable time, money weighted rate of return is losing very badly. So the consistency in terms of measurement is very badly affected. So the typical expectation is time weighted rate of return, which does not depend very heavily on the timing of the cash flows when a new cash flow is added or when something is withdrawn. That is more preferred in the industry compared to a money weighted rate of return, because on one side money weighted rate of return can be more and more can go more and more also if more funds come during a high performing period, but still the consistency is a bigger problem. So that's where we see that the time weighted rate of return takes a lot of precedence compared to the money weighted rate of return. So we can find out the holding period rate of returns, holding period returns for the different holding periods. So overall, even if it is a 3 years, I multiply all the holding period rate of returns and try to and whatever the product that comes, I can take it to the power of 1 by 3, or I can take the geometric mean of the same. But at the same time, if the holding period rate of returns are lesser than, let's say, the first quarter, the second quarter, the third quarter HPR, the fourth quarter HPR are there. Again the same logic, probably if I multiply all 4 of them, that is what is going to be my return for the year. The compounded is nothing but the return for the year. There I don't need to take any kind of a geometric return, because that's the entire return for that year itself. So whatever is that, the whole compounding will tell me for what is the total period for which that particular return is associated, and based on that I can see whether I should really go for taking a geometric mean of it, or I can very well manage it out with I can very well just do the multiplication of all the 1 plus HPRs to compute the annual rate. So whatever is the period, from that particular period we are trying to annualize it to get our rate of return for that particular period. So just in a simple essence, we are focusing on that particular mechanism in terms of the accurate portfolio return measurement, because among the money weighted rate of return and the time weighted rate of return, more preference will be given to this time weighted, because that looks more and more accurate from an investment fund management perspective or investment fund evaluation perspective. As we have discussed, the fund addition and deletion may not be in the control of the fund manager, but may be in the control of the clients, who can act it to their based on their availability and based on their requirement. So so using an appropriate measure will always help in terms of arriving at better decisions and better performance appraisal of the funds. So that's one more important concept. Probably understanding of the discounted cash flows and the concept of holding period returns will really help us in taking better decisions in this particular context. Alright. Now, the other important concept that I would like to present in this context is the concept of money market yields. What I mean by the money market yields is, see, till now whenever we have been discussing about NPV or IRR, we talked about the opportunity cost of capital is more and more market determined. So we just need to understand how that particular returns come out from the market. So generally we look at some of the money market instruments and how they are typically how the interest rates are being determined based on this money market instrument. So whenever I talk about money market, it's more of short term debt market, right? Short term borrowings, typically for less than 1 year period, those kind of markets we are calling as money markets. What we see is in the money markets, some instruments are available as some instruments are probably available wherein we are talking of, if I have purchased that particular instrument at if I have borrowed X, then probably on maturity I have to pay X plus interest. So these are typically the interest based or purchase price based instruments. Whereas on the other side we see a kind of instruments called pure discount instruments, where we see the interest is typically taken as the difference between the amount borrowed and the amount that is paid back. And so basically the difference is, in pure discount bonds we see that the interest is quoted as a percentage of face value, which is the amount paid, not the purchase price. The return, not the borrowed amount. It is paid on the repaid amount. So that is the percentage is computed based on the repaid amount. As a percentage of the repaid is what we consider the interest. Whereas when we are talking about the price based ones, we consider always as a percentage of the purchase price, not the payable price. So that's where we see some instruments which are purely based on this. There are some instruments which are purely quoted on this particular basis, which means I need to have a mechanism to do an appropriate conversion between these kind of instruments so that I can compare them for my investment purpose. The most common kind of securities, the treasury bills, or we see commercial papers, which are kind of short term borrowings done by corporate. These are typically discount based instruments. They are discounted based on the face value, which means the face value is something that is paid on the maturity. Based on the discount that has been offered, the purchase price, whatever we are paying, is the face value minus the discount. So the discount in terms of percentage is applied on the face value, and the remaining is what is being typically paid. That is what is the typical the discount based bonds approach. But when we are talking about certificate of deposits, which are again short term borrowings which are done by the banks, what we see is they are priced on their rates are quoted based on the purchase price itself. So they are typically interest bearing kind of instruments. So we call them as interest bearing. They are not pure discount instrument. So whatever is the interest rate, that is purely quoted as a percentage of price. So we need to have a mechanism to understand how each one of them is typically a price, and how we can convert from one form to the other, so that proper investments can be taken and proper investment decisions can be taken. So let's look at some of them. So here we talk about a few important kinds of yields. I talk about the bank discount yield as one of the factors. Then I talk about the effective annual yield, which is same as effective annual return that we typically called earlier, which is purely based on the holding period return. Then I am also bringing in the concept of money market yield. Now, what each one of them mean? See, there are some instruments like treasury bills, as I have talked of, they are purely quoted on a discount basis. So they are not quoted not on a price basis. The quotation for them is not on the purchase price. It's purely based on the face value. The discount is not, so it's a discount. It's a discount to the face value. The interest rate is not based on the price. And the typical way we are talking about the bank discount yield is whatever is the discount that we have got, take it on the face value and look at it, annualize it in the form of 360 by T. If I am talking about a 30-day or a 120-day kind of a treasury bill, you just find out the annual interest rate in this particular mechanism. So probably it's better that I take up another smaller example which can help us understand the different kinds of interest rates in a simpler manner. So I am talking about the face value which would be paid on maturity. Let's say I am talking about 10,000 bucks. The current purchase price. The current purchase price for the same, let's say, is 9,700 bucks. Right, I am talking about a purchase price of 9,700 and the maturity period, the time to maturity, let's say I am talking about it as 200 days. Right, I am taking the time to maturity as 200 days. And let's say if I am going with the bank discount yield mechanism. The bank discount yield mechanism, if I want, first thing I need to compute is the discount. So here the discount I will take with respect to the face value. So in this case I am getting a discount of 300. So if I am going with the bank discount yield mechanism, I am looking at a formula like the discount divided by the face value. So there is a 3% discount, but that I am taking it as 3 multiplied by 360 divided by time to maturity. So overall it is saying that the bank discount yield is giving me a 5.4% as the interest rate during this particular period. So this is the way the bank discount yield is being computed, but in reality probably it's not a meaningful return. The bank discount yield, we don't look at it as a reliable or a meaningful return for a few things. Typically I can look at a few important drawbacks with it. One, the yield or the return, it's always should be computed based on purchase price. It should not be based on based on the selling price or not on the face value. So a discount is not equivalent to a yield. So that's one of the prime reasons I cannot use it directly as a performance of the investment measure. Secondly, this is considering a 360-day year basis, whereas it should take it on a 365-day year. And this is purely doing a computation on a simple interest, whereas I require a compounding during the period, because this is a 200-day investment. So it's better that I take the compounding for the remaining 365 days, but this is doing an annualization on a simple interest basis. So from that dimension, probably bank discount yield is just from a quotation perspective, but directly I cannot compare it with something else to typically say that I'm getting a 5.4% return in the investment that I'm making. So just to make things slightly more effective, we will depend on a mechanism called effective annual return or effective annual yield, which takes into account the holding period yield first of all. So I'll consider the holding period yield to start with, wherein I'm getting the final value minus the initial value and no intermediate payments during this period divided by the initial value. So my holding period yield for this 200-day period, the holding period yield is going to be something that much. Now what we are saying is, based on that, I will do an effective annual yield. I'll take an effective annual yield wherein I am looking at the holding period yield. I am annualizing it over a 365-day period. So I am taking 1 plus the holding period yield raised to the power of 365 divided by 200, because I am doing a compounding of it here. I am not looking at it as a simple interest. So the effective annual yield in this case actually is giving me 5.71%. So this looks like even more a realistic alternative, because first I am trying to find out the holding period yield, and whatever the holding period yield that I have got, I have converted it by simply annualizing the same. Then, though this is much more effective in terms of comparison, but again we have another major measure of measurement that is available in the market. The other one being called as money market yield. What I look at as a money market yield in the market, which is otherwise called as the yield corresponding to the certificate of deposits, the money market yield. What we look at it as is the holding period yield multiplied by 360 by T. Even this one takes with respect to the 360-day period itself. So the holding period yield multiplied by 360 divided by the T. So this is saying me 5.56 or 5.57% is the holding is the money market yield. So money market yield is generally larger than the bank discount yield, because the money market yield is taking the holding period yield rather than the discount rate. So here we are seeing that the discount rate is just 3%, because we are doing the discount based on the face value, whereas the holding period yield is doing the computation of the return based on the purchase price. So because the purchase price will always be lesser compared to the face value, the holding period yield will be greater than the holding period yield will be greater than the discount percentage, and both of them are multiplying with 360 by T. So always we will find that the bank discount yield will be lesser than the holding period yield itself. Now, the another important thing that we need to be comfortable with is, how do I convert from one form to the other? Probably if someone has given me a bank discount yield is 5.4% for a 200-day maturity. Now, how do I find out what is the money market yield for that? What do I need to do? Now that I know that the bank discount yield is 5.4%, let me try working out. This is a very easier way to work out. The bank discount yield is 5.4%. So the discount divided by the face value multiplied by 360 by 200, assuming a 200-day period. So this is what is working out to discount divided by face value. So discount divided by face value comes out as 5.4% multiplied by 200 and divided by 360. Okay. So this is what is coming out as D by F. The moment I get D by F, I can assume that F is 100, right? I will assume here F is 100. So based on that, I'll get my D, which is this much percentage of F. So based on that, I can compute the purchase price, which comes out as 100 minus 3. Based on that, I can find out the holding period yield, which works out to 3 divided by 97. And based on that, I can find out either effective annual yield or the money market yield, depending on what I need to compute. The money market yield for me is this multiplied by 360 divided by T, or if I want the effective annual yield, once I have the holding period yield, I can take this to the power of 365 by 200 minus 1, which is again working out to 5.72%. So interconversion between different kinds of yields is also very much necessary to typically compare what kind of instrument, what is the effective return that it is generating during this entire process. A good understanding of all these things will give us a good comfort level in terms of using the various DCF applications in the real finance world, and really helps us in taking the decisions quite effectively. So just as a summary, in this particular session I have focused on three major aspects, discussed a little bit more on NPV and IRR and how the capital budgeting decisions and project investment decisions can be chosen using the DCF based application. Then we have looked at the portfolio management, portfolio appraisal mechanism or portfolio measurement mechanism, how I can use the DCF mechanism or probably the concept of holding period returns and probably the concepts of money weighted rate of return and the time weighted rate of return to typically take investment decisions. And finally, we have spent time in terms of understanding the different money market yields, where we talked about how again the DCF is helping in terms of conversions from one form to the other, or different kinds of yields that are available in the market, right from the bank discount yield to effective annual yield to the money market yield and the kind of interrelationships that are present between them. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.